So today we're going to go over crowding out, topic 5.5, and we'll cover 5.5 and 5.6, hopefully get into 5.7 as well. All right, so crowding out. Now, we talked about earlier when the government borrows, right? I'm on slide 5, if you guys are following along. When the government borrows from the when the government starts to deficit spend, right? Just like they did right now, they're deficit spending. They need to go to borrow that money out, right? And a lot of times what they'll do is they'll go to private institutions and borrow that, or the loanable funds market, and take out loans. Now, what that has an effect on when you and I or an industry goes and takes out a loan for a business. And let's look at that effect that happens, right? So this is supply, demand. On the vertical axis, you have real interest rates. And then you have quantity of loans, right? And so what we're concerned with is interest rate, right? Because when you go to take out a loan and you have to pay it back, you have to pay it back with interest. So you want to make sure that that interest rate is low because you don't want to pay back more, right? So if the government comes in and they're looking to deficit spend, and then they need to take out a loan, right? So they're going to demand more money, right? Or they're going to demand loans. So what's going to shift is the demand curve, right? And then so what happens to interest rates, as you can clearly see, I mean, this is a simple supply and demand graph, right? So if demand increases, then your vertical axis will increase, meaning interest rates are going to increase. Interest rates increase, right? And so now what has the government done? Well, let's think about that. The government deficit spends to get us out of a recession, right? To speed up the economy. They want consumers to spend. They want businesses to spend, right? Interest rates should already be low. So what's going to happen when the government comes in and they jack up interest rates? The interest rates, the Federal Reserve is trying to keep the interest rates low. Why? Again, because we're in a recession and we want to speed up the economy. So they want to speed up spending. So what happens is that you raise interest rates and now you've discouraged consumers and investment, both C and I, you've discouraged them from spending. So now you're not fully impacting, like moving out of that recession, right? You could be furthering the recession through deficit spending, right? Or through those loans because you've now raised interest rates. I hope that makes sense to you guys. Okay, so let's go ahead and move on to slide 6. So assume the government increases deficit spending. What will happen to the demand of loans, the interest rate, and private domestic funds? So we've already seen what's going to happen. The interest rates will increase, the demand, the quantity of loans will increase, right? But what's going to happen is consumers and investors will probably not borrow as much because they've been crowded out of the market, right? So the total number of loans increases, but due to public borrowing, private borrowing decreases, right? So you'll have less private borrowing. So crowding out is going to be the adverse effect of the government borrowing on interest-sensitive private sector spending. And that's just what I kind of just explained to you guys, is that the government, they come in, they borrow, right? That pushes the interest rate up. The interest rates goes up. Consumers and consumer spending and investment are going to decrease or be weary about taking out loans because the interest rate is a little bit higher. Okay. So that is 5.5 real quick, right? Let's go ahead and move on to 5.6. Now, 5.6, the topic 5.6 is economic growth, okay? And so now looking at economic growth, so what do economists use to measure economic growth and the standard of living? It is not nominal GDP, since it does not equate for inflation, right? It's not GDP because it doesn't account for the population. Real GDP is the real GDP per capita is the real GDP divided by the population, right? And then the growth rate is the change in real GDP per capita over time. So what are the characteristics of countries with higher growth rates or with high growth rates? The ones with higher growth rates are going to be the countries that have economic systems, rule of law, capital stock, human capital, and natural resources, right? We've kind of already talked about this. This is kind of a little bit of a review from the beginning of the class, right? And we talked about how these 5 different things push your country or put your country in a better position to have economic growth. Now, what economic growth is basically is productivity, right? It's how many things you individually can make, right? So output per unit of input, right? So how much you're able to take in and how much you're able to push out because of that, right? And so if you think about it like rule of law and the idea, one big thing is rule of law and the idea of the government protecting your ideas, right? So like, or patents, right? So, or copyrights, right? So like you feel protected to be able to produce those things. And since you feel protected to produce those things, you're going to want to make more innovative things, right? So if the government's going to protect your idea of coming up with a coronavirus vaccine, right? Then you're going to be more motivated because you're going to see the profit in the end to produce that, right? And again, we've seen all of these things before. We've seen economic systems, right? Mixed economy, and then command economies and the free market economies, right? And then we've seen capital stock. We know what to talk about. Capital stock is machinery, right? That produces other stuff, right? Human capital, of course, is the educational level that people get or the training that they get to become better or more productive, right? And then natural resources. So all natural resources are, water, how fertile your land is and whatnot, okay? So real simple, we can look at these production functions, which I don't think are going to be on the AP test, but just so you kind of have an idea, you just look at them. I'm looking at slide 8 and 9, and you can see just the productivity and the GDP predictive levels because of diminishing returns. You guys, those of you that took micro, remember that diminishing returns is, or Danielle, for you, the Swiss eating roll competition, right? You're going to get to a point and then you're going to start seeing negative results, right? Or economies of scale, right? Ryan and Jonah, you'll remember those. That's what we're going to see here as well as economies of scale. But you can see that as you become more productive, of course, you're going to be producing more GDP, right? So this makes pretty good sense, or should make pretty good sense for us. Okay. Now, let's go ahead and jump to slide 10. So showing economic growth and ADAS and the PPC. Now, remember that when we talk about the long run, you see here on this slide, we have you have a simple ADAS model on the left, and you see the long run aggregate supply curve shifting to the right. Remember that long run aggregate supply curve is shifted because of capital stock. So the more capital stock you have, right, then you shift that to the right. Now, it's the same as producing more in your PPC. So if you shift your PPC outward, of course, you're going to shift your long run aggregate supply curve out as well. Okay. And then depending on what happens in the economy here, we're showing that there's a shift in aggregate demand and then a shift in aggregate supply, putting you at long run aggregate supply. Okay. So the increase in consumption and net exports doesn't cause economic growth, right? And that makes sense, right? Because those two are only going to manipulate AD, right? So you'd shift AD. Now, investment causes firms to increase their physical capital. So investment would be the only one, because you're increasing your capital stock. That's the only one that's going to shift your long run aggregate supply curve to the right. Now, you can also lose capital stock, right? I mean, that's a possibility. So you would shift it to the left as well. So let's think of like a shipping company, right? And they only have one ship and a very simple, example, right? One country has one shipping company and they have one ship, right? And so they're trading with, several other countries. Well, our long run aggregate supply curve is going to stay, it's not going to move very much, right? But if we start adding ships to that, we are now getting more materials, right? Those more materials, right, that we're bringing in is now we're able to produce more, right? So now we're seeing more economic growth. So that would push our long run aggregate supply curve to the right, because we've added ships to our shipping facility, right? So now we're able to bring in more resources. And so that's adding capital stock, right? And that capital stock, again, is an increase, which pushes long run aggregate supply to the right, okay? I think I took that example from an FRQ, and I think that FRQ is, you guys can see that on slide 16 and slide 17, okay? So that is 5.6 for us. Let's go ahead and move on to 5.7. And that should be it for the AP test. Okay, and then this one is going to be discussing 5.7. The topic is public policy and economic growth, okay? And so, what government policies most likely result in long-run economic growth? There's three policies, right? There's education, training, and then there's infrastructure, right? And then there's productive investment incentive programs. And we'll talk about each one of those for economic growth, right? And so education is, we want to improve human capital, right? We want to make people smarter, right? Or more intelligent. Okay, and that's why education is so big, or that's why we're so big on education as far as getting at least a high school diploma. Infrastructure, right? If we have better infrastructure in the United States, meaning we can move goods in this country faster, right? To one another, then that makes us more productive, right? And this is also going to increase our physical capital, right? And then production investment incentive programs. So let's say the government gives businesses, and they just did incentives, right? And that's the big thing about economics, is like, what's the incentive, or like, how do you incentivize stuff, right? And so the government just incentivized, giving out loans to small businesses if they didn't fire their employees, right? If they kept them on payroll. Now these loans were forgiven after, a course of some time because of the pandemic and everything that's going on right now. So the government forgave those loans and incentivized that. That's the same thing here that we're talking about, is, let's say the government gives you a tax break, right? A lot of companies that come to El Paso, as a matter of fact, they get a tax break from the city government. Why? Because they're trying to incentivize them coming here, right? I think like iFly and Topgolf, like, they don't have to pay back the taxes, or they don't have to pay back as much taxes, or pay as much taxes, because they're on a reduced scale until that runs out. So, and that, of course, the reason why they do that is, they want to draw businesses here to El Paso. And by drawing business here to El Paso, what's that going to do? You're going to create construction jobs. You're going to create, jobs from Topgolf or iFly or wherever, right? And then they're going to eventually start paying property tax on there, and then the government, the city government, will get their cut, right? So, and that's of course called supply side or supply side economics or supply side policies. And Trump's, that's Trump's policy, right? Is let's focus on the business person. The business person will eventually take care of the individual, right? All right, so supply side fiscal policies, the government policies designed to increase production by reducing business taxes and or regulations, right? And so, this country does have a lot of regulations attached to it, and that's, natural regulation or like natural resource regulations, pollution regulations. Coal was a big one that was regulated. So because it has a lot of pollutants that are involved in coal mining, and so because of that, is heavily regulated. Well, the Trump administration came in and they relaxed some of those regulations, right? And that, creates jobs and does that. Now, that's an internal argument that you can have with yourself, right? Is do we want these heavy regulations for the planet, right? Or these environmental regulations, or do we want these jobs, right, that come with it? And the trade-off with these jobs is that they're going to cause a little bit of pollution, and so, or little, lot, whatever, I don't know, whatever. And so that's something that you internally need to figure out, like where you lie. And just because Trump uses this, right, I'm not saying that this is a bad thing or a good thing. I'm just saying that, hey, he uses supply side economics. Ronald Reagan used supply side economics and kind of almost coined the term of supply side economics in his, he was in the Oval Office, and he has this this supply and demand graph, and he's trying to explain to the American citizens about supply side economics. So I'm not saying it's good, I'm not saying it's bad. It's just that's something that you need to figure out as how you're going to vote, and if this stuff's okay for you, and for some people it is and some people it isn't, right? So anyway, how does that necessarily affect the LRAS? Well, in the long run, government decreases corporate taxes, right? And so if they decrease corporate taxes, right, what's going to happen? You're going to see a shift in aggregate demand first. So we will be in an inflationary gap. And then because supply is now increasing, right? Or now we can increase, aggregate supply is then going to increase. So you'd see a shift to that. And then since we were talking about investment, right? We're assuming that there's going to be more capital stock. And because there's more capital stock, you're going to shift the long run aggregate supply curve to the right. So, and you can see that all happening on slide 9, right? So just to kind of sum up what I said, in the long run, wages and costs increase, right? The government doesn't necessarily result in economic growth, only spending that increases productivity and or technology, right? And so that is it for Unit 5, right? So I'm going to go ahead and stop the recording.